It is Sunday, September 16th, and I haven't done a video update on the markets in a couple of weeks, so I wanted to offer my take of what's going on here possibly and show some charts and some data. This is the Dow Industrials, and this is a monthly chart. This is a MACD study underneath the monthly chart, and what I want to talk about here is the multiple time frame momentum setup, because it's very, very similar to what we just saw happen in bonds over the last couple months, and I think both of them imply there could be large downside for both stocks and bonds. But I want to click through this chart by chart here. So this is the Dow, and in this MACD, the MACD is potentially overbought, or it's above the zero line, and what we're starting to see is on the peaks from May 2011 to April and May 2012 to the current peak at a new high, we've seen successively slightly lower highs on the on the MACD line, on the light blue line there. So there is some very mild bearish divergence even on a monthly time frame, and it is possibly overbought. Could potentially cross down if we see any weakness in the future here. Now if we click to a weekly chart of the Dow, this is a MACD study under here, and you see as the market has made a new high above the highs earlier this year, there's a relatively sharp bearish divergence. So this MACD is quite a bit lower than it was in April and May, and that itself was lower than the peak in 2011. So we have somewhat of a weekly three push pattern here, where we have a high, a pullback, a lower high, a pullback, and a lower high on the indicator, with successively higher highs on the price. And if you look at price itself, the price is also forming a wedging type of pattern. So we had a long first leg up from here, peaking the MACD indicator at this level. We had a pullback, we had a shorter leg up to here, and then we had a smaller pullback and a shorter leg up here. So if the market were to top in this area, it would be a nice kind of ending diagonal pattern, which are very, very common to end a pattern of a larger degree as far as Elliott wave terms. And the implication with that would be is if we do see this lower trend line break, and particularly if we see this move up since June, if we see that completely retraced in less time than it took to form. So let's put some numbers on that. If we see that retrace basically by Christmas time, then that would be an indication that the trend has logically shifted to down, and the target would be probably at a minimum down to the 2010 lows, just based off the fact that this should correct this entire larger pattern here. Now that's the weekly chart. What I wanted to go one more level down to the daily chart and show that even within this leg up since June, the MACD peaked out here in mid-August, and then it pulled back to the beginning of September, and then on this new move up here, there is yet again a divergence, bearish divergence on the daily time frame. So we have mild divergence overbought on the monthly, we have strong divergence overbought on the weekly, and we have some mild to moderate divergence from overbought on the daily. So there is a multiple time frame setup here that is potentially very, very powerful for stocks to put in a top here. And I showed a very similar thing happened on the bonds, and I may review that before I end this video. Another thing I did want to point out, and I don't go over this type of thing often, but just go over the couple long-term trend lines here. This is a trend line between the 1937 highs. This is a yearly, quarterly chart of the Dow, so this goes back to the 1910s here. A line connecting the 1937 high and the 1966 high has been an interesting trend line to follow, in that once it got exceeded here in the 1990s for this kind of blow off top, it found support at that level at the 2002 bear market, and then when it broke through this level in September of 2008, the market experienced a dramatic waterfall type decline there in the so-called crash of 2008, and then every time it has come up against that line here in 2011 and 2012, it's experienced a correction. So that being said, there's also declining lower highs on the MACD. So if the market fails here, we could view this as a continuing divergence or bearish divergence on the even the quarterly chart. Obviously, there was a sharp divergence between the 2000 high and the 2007 highs if you look at this MACD relative to higher price highs. So just on a long-term basis, we may have be seeing the market making a very significant high here. For confirmation, again, what we want to look is see the current move up since June be retraced in less time than it took to form. So the specific date on this chart would be, assuming the market made a high on Friday, which I'm not saying it did, but let's just say it did. We would need to see the market back below the June lows by Christmas to New Year time frame. Now, if this is a ending diagonal type of pattern or ending wedge pattern, oftentimes the entire wedge will be completely retraced in half to a third of the time it took to form. So that seems pretty outlandish, but what I'm saying here is that this move up since 2010 may be retraced completely by spring, by summer to in between this line here and this line here. So a move up that took a couple years might be retraced in a year or less than that. So those are just some long-term pieces of information on the pattern and everything, more applicable to the investing time frame. What my suggestion here is, it's certainly possible the market can do anything, so have some trailing stops in there if you're in long positions. So we've seen a support level here in the market. We've seen a pullback after a failed breakout of the highs here, and then the market exploded past up there this year on some news-related items. So this would be a pretty safe stop level. If you think about the psychology of it, we had this news from the Federal Reserve on their new quantitative easing plan, and the market really shot up on that. So if the market comes back below this level here, that would call into question whether this last move on that news was truly part of a stable trend, or whether that was kind of like the final blow off or capitulation type of a move on this entire upward pattern. As another point of reference, when there is a wedge type of pattern, it's very common for, if you draw a point between the first and second highs of the wedge, for the final high to exceed that trend line and do so on a volume spike, which we did see. Let me pull this up here on the let me show this on SPY here. There was a very large volume spike on the SPY ETF. So on that day, on Thursday, when that news came out, the volume spiked up to a very high level. Usually you see volume spikes on down moves like we saw here, and then here, but there was a volume spike on that news-related announcement. So just another point to say that that fits with the pattern analysis there. Now, what I did want to show is some information on the Commitment of Traders report here. First off, this is the Commitment of Traders index I've constructed here, and the current reading makes this the index at the most bearish level in the last couple years. So the most bearish level actually since May 2011, and we saw the market put in a high when it hit this level here. We saw the market make a mild correction here a couple of weeks ago when it touched this level. But in any case, we are seeing the market give us essentially a sell warning here. Now, that's not a signal until we get some type of a technical signal, and you need to control risk when you're taking these signals. But we're giving us a sell warning here because the smart traders, what this means is they are selling to a very extreme degree. Now, if we look at their the net positions, which I believe I showed this on the blog a week or so ago, the commercials are net short, so 0 would be a neutral position, very negative here would be net short position, very positive here would be net long. So when these smart money or commercials are net long, like they were in August to September of 2011, after we saw that brief waterfall decline last summer, we should be looking for a market to bottom and be taking technical buy signals, and that would have worked very well if you did that. And what we saw here is back in May of 2011, and then again in a slightly higher bottom on the commercial net here in July of 2012. Those are warnings to us that that's the most net short they've been in a few years, and you may want to take net technical sell signals. This was the high of 2011, and then this was a lower high. Both of those would have been good sell signals. What we're seeing is the market now back up in that range currently here. So again, it's just a warning, sell warning, that you could take technical sell signals and understand that you're more or less going with the smart money if you're doing so. So what I just showed on the multiple time frame momentum is that there's this great bearish divergence setup on multiple time frames, and it's right in line with commercials heavily selling this advance. So you may want to have very tight trailing stops on long positions or investment positions or growth stock positions. If you've been in those for a while, you should have some gains on those. So it's the hard part is selling at the right time. So my suggestion again would be, if you don't feel like you want to bail, if you think this rally has legs to it, well, fine, just put stops in below those and let them trail up behind the market. So if it continues to plow up from here, you make some gains. But if the market is indeed putting in a significant top and a correction like we've seen at these other highs, then you're at least protected there, and you could potentially buy back at a lower level in the future. One point I did want to note out here is this chart is showing the spread, or the difference in long and short, of the smart money commercial traders, and this chart here, actually the small traders, so the true dumb money. A chart of the commercials versus the large speculators, which would also be considered dumb money. It would look very, very similar to this, but this goes back to 2006, so there's a lot of data here. But in general, what we've seen, at least since the bear market low in 2009, is that when the spread has gotten very low here, so commercials are very net short, so they're very negative, or what that means is they're net short, then we've seen tops happen. So this was back in, again, May of 2011. This was back here in June of 2009, prior to the significant correction into July of 2009 there, pulled back about 8 or 9%. We obviously saw about somewhere around a 20% correction here between May and September, October of 2011 last year. So we're back down in that region here. So again, just a point to say the market is to some extent out of balance from its tendency or its average here, and that would be set the stage for a possible pullback. So that's really what I wanted to cover on stocks. Again, my take is that while this feels very, very bullish, and we have this news announcement from the Federal Reserve that they're going to support the market and all this stuff, and we always hear those type of things. All of that is factored into price, and if you learn to just filter out all that noise, possibly look at it from a psychological standpoint, but just look at the price and the momentum and go from there, I think that's, in my experience after following markets day after day for years, is that it'll be more fruitful to really just look at the price and put that in context, and not get too caught up in some of those news-related items and rationalizing what they're going to do to the market in the future and that type of thing. So let me briefly just show the setup in bonds, because I want you to look at this chart here of the Dow and see this wedge type of potential top pattern here, and this MACD 3 push pattern here. And let's look at bonds, and we saw the reverse thing happen over the last couple years in bonds. So this is a chart of the 10-year bond yield. So we saw a similar wedging type of pattern happen to the downside here. We saw the MACD. This is a weekly chart of bonds, so this goes back a few years. But we saw this beautiful bullish divergence in the MACD relative to the lower price lows in the bond yields. And then if we look at a daily chart, is what I had said when the market was at these levels here, is we should see the market, the bond yields go below this low here to set up that weekly divergence, and then what we want to look for is a bullish divergence within this leg down itself. And so when the market got to here, we saw a little pullback, and then we saw another slightly lower low in the yields, but we saw this again, a nice bullish divergence on the daily time frame there in the MACD. And then if you looked at the monthly time frame on yields as well, between some of these lower lows in the bonds, we were seeing some maybe mild divergence. I don't know if it shows up as well as that as it did on the 30-year. Well, I don't have the MACD on here, but there's a very strong divergence between these lows here and this low here on the 30-year yield. So, point being, what we saw in the bonds after that nice setup here is after we completed that daily time frame bullish divergence. And you could just flip this around for if you're looking at the Dow or stocks right now, is once we saw that MACD cross up after the divergence, we did see a sharp rally in the bonds, so that would imply a sharp sell-off to come in stocks. We did see a pullback here, but now it's crossed up again on the MACD and it's pushed up to new highs. So I again would think that, and even looking at the trend line here, the trend line down in the bond yields was broken this week as of Thursday and Friday in the yield, so that may be an implication that we are set to see some consistently higher interest rates. And if you look at the speed of this decline here, this advance in yields, decline in bonds, it was faster than this decline was in yields. So there's some logical confirmation that at least this leg down here is being corrected. If we start to see some real explosive move up in yields or decline in bonds, we would have to gauge, to what degree that's correcting this entire move down. So I just wanted to show that because that was something I highlighted in bonds, and it's worked out nicely. We've seen a significant change in direction there. Not extremely long term at this point, but for the short term, it's definitely worked out nice and is given a nice potential trading opportunity. So again, that's what I think we should be looking for here in the stocks. Clicking back to the stock charts here. So again, look at this MACD, wait for that MACD to turn and cross down. That would be, assuming that happens soon while this is still showing a divergence, that would be an excellent technical sell signal to either close longs or possibly take short positions here. However, the market does continue to move up here and we see this MACD make a new high above here. My suggestion would be to hold off on that trade and wait for either a new divergence to develop, or for stocks to then come down below these trend lines here, this red and this black trend line. So maybe they push up higher and they fall down below the trend line and then put in a little rebound that puts us below the trend line. And then if you get another technical sell signal like MACD or stochastics or something after that, then you could look to short there if you are looking to go inverse to the market at this point. But that's my take on this. Overall, pretty nice setup. Be careful if you're long here. You're going against what the largest money and smartest money traders are doing at this point. So just have stops in, lock in profits if you're long, and if you're looking to short, then keep a close eye on these technical sell signals. If they happen soon, they could be very high quality sell signals. So that's all for this update. I'll look to do a post here if there's any significant developments over the next couple weeks.